Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Vale stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Vale is a mining and logistics company. It is the largest producer of iron ore in the world. It produced 300 million tons in 2020. Its target is 400 million tons in 2022. In the third quarter of this year, it produced 90 million tons of iron ore. It has 4 systems in Brazil for producing and distributing iron ore, which they call the Northern, Southeastern, Southern, and Midwestern Systems. The Northern and Southeastern Systems are fully integrated, consisting of mines, railroads, maritime terminals, and a port. The Southern System consists of 2 mining complexes and 2 maritime terminals. The company also operates 11 pellet plants in Brazil. 98% of iron ore is used to make steel. Steel is used in many things such as buildings, infrastructure, roads, bridges, medicine, auto parts, etc. The Evergrande situation seemed like it was going to really affect this company since China imports 75% of the world's iron ore. Evergrande is the second largest real estate developer in China. The company seems like it's on the verge of bankruptcy, but every time in the bottom of the 9th inning, it somehow obtains cash to pay the interest on its debt and just avoid filing bankruptcy. The company has a whopping $300 billion of debt, so there are many hurdles to cross for the foreseeable future. I was really surprised when the company recently announced it's going to give priority to its electric vehicle business over its real estate arm. Let's get back to Vale. They are the largest producer of nickel in the world. Nickel resists corrosion and is used to plate other metals to protect them. It is an important material for the batteries that are used in electric vehicles. It is also used in kitchen products, mobile phones, medical equipment, buildings, and jewelry. The company produced 215,000 tons of it in 2020. The company has a massive logistics operation in Brazil and other parts of the world. This is just another reason the company is so profitable. It controls every part of the process, from mining to crushing to treating to shipping, everything. It has a network of railroads, marine vessels, distribution centers, and ports. It is part owner of MRS Logistica. MRS transports the iron ore products from the Southern System mines to its maritime terminals. It also charters dry bulk vessels to transport the products to its customers. In addition to iron ore and nickel, it also produces manganese, ferroalloys, copper, bauxite, potash, kaolin, and cobalt. The company is really trying to make efforts to improve its ESG. They relinquished all mineral rights located on indigenous parts in Brazil. Vale gave up 104 mining locations that were interfering with native people. The company is really trying to put people's well-being before profits, which is a noble gesture on their part. Another one of their ESG initiatives is the use of an iron ore briquette, which will reduce up to 10% of the greenhouse gas emissions in steel production. It also provided 1 million food baskets to over 200,000 poor families in Brazil. As you can see, this company goes above and beyond to try to help the communities it operates in. The company is headquartered in Rio de Janeiro, Brazil, and was founded in 1942. It trades on the New York Stock Exchange, Mexican Bolsa, Spanish Bolsa, Sao Paulo, Deutsche Börse, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 60 billion market cap. They're trading at $12.28 a share, and they have 4.9 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have a ton of free cash flow, $8 to $10 billion a year. Then it jumps way up to $25 billion. Free cash flow is a cash flow that's remaining after paying all your expenses and investing back into capital expenditures. So it's a cash that's left over for you, the investor. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that also peaks in the trailing 12 months at $18 billion. Revenue is the sales for the company, and that grew a lot from 37 billion to 57 billion. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their 2020 revenue by country. More than half their revenue comes from China, since they import the most iron ore. Then second is Japan, so you can see the company's really concentrated in Asia. US is only 1 billion, 1/40th of their revenue. They sell products all over the world, which can benefit the investor, because if they were only selling to one country and that one country was in a recession, that company and the stock would really struggle. But when you sell to many countries, you're not just relying on that one country. Here's a breakdown of their 2019 and 2020 revenue by metal. So more than half is from iron ore. The next biggest is nickel at close to 5 billion. Iron ore pellets is pretty big as well. It's much more efficient to transport iron ore pellets than the raw iron ore, because when you transport the raw powder, there's much more leakage. You can lose some of it throughout the process. But when it's in pellet form, there's not much leakage. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. The cost of labor and the cost of products is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that was so much higher than 2018. They're producing a similar amount of products in each year. It's just the cost of the product is going up so much, especially the cost of iron ore. It's increasing so much, it makes them look so efficient. Below that is their operating expenses, then their operating income, which also peaked in the trailing 12 months at 32 billion. They pay 2.6 billion of interest on their debt, and they usually pass through lots of losses or write-downs each year. So that brings down their net income. That's why it was negative in 2019. But you'll see in a statement of cash flows, they actually generated lots of cash flow. This is the income statement from their annual report, so we can get a little more information. So in 2020, they had 554 million in SG&A. This is rent, payroll, insurance. Research and evaluation is 443 million. Then there's pre-operating or stoppage costs. Because sometimes there's problems out of sight, sometimes there's strikes or things like that, and work has to be stopped. So the company loses money. A big reason they had a loss in 2019 was from the Brumadinho event. They passed through $7.4 billion of losses, 5.3 billion in 2020. In January 2019, in the city of Brumadinho, a dam collapsed and killed 270 people. It also caused extensive damage, so the company has been paying a lot for that. It's a really unfortunate event that the company, of course, didn't want to happen and is going to try to avoid in the future. That's a reason they're paying a lot of fines and expenses. This also could be another reason people aren't buying the stock. They just think negatively of this company for killing all these people in this town and ruining a lot of lives. They mention here they allotted 13 billion reais for impacted families. Also in 2019, they passed through over 5 billion of impairments. This is when the value of an asset is lower than the value on the balance sheet. So you reduce it on your balance sheet and pass through a loss onto your income statement. This is a non-cash item, so it doesn't affect cash flow. It's an accounting loss. I like that they broke apart current taxes and deferred taxes. Current taxes are taxes that are due now. Deferred taxes are taxes that are due or owed to the company in the future. The way deferred taxes comes about is a difference between the way a company calculates taxes and the way the government calculates taxes. So when there's a difference, the company has to carry a deferred tax asset or deferred tax liability on their balance sheet because they have to pay the taxes the government says, not what the accounting rules say. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. This is the cash that's remaining after paying all their day-to-day expenses, payroll, taxes, cost of materials, $30 billion left over. This is the most they've ever had. And it's so high in the trailing 12 months because iron ore prices have come up so much, so they're making so much money. Their margins are through the roof. They spend a ton in CapEx, $3 to $5 billion a year. They have lots of infrastructure costs. The railroads, the ports, the mines, all the machines and facilities to process the metals. It's really expensive, so they have to always buy more or spend more money to maintain what they currently have. Operating cash flow minus CapEx gives you your free cash flow, and that's the cash that's remaining for you, the investor. That's why they're paying a massive dividend, because look at all this excess cash flow. They did add $300 million of debt in the trailing 12 months, but paid down $2 billion. So they reduced their debt load $1.7 billion. They reduced it $6.5 billion in 2018 and $2.5 billion in 2019. And they bought back nearly $5 billion worth of stock in the trailing 12 months. When a company buys back stock, that decreases the shares outstanding. It makes your shares more valuable. And they have plans to buy back even more stock over the next 12 months. They also bought back $1 billion of stock in 2018. This is the company's statement of cash flows from their annual report, so we can get a little more information from their reporting. The middle section is cash flow from investing, and the top part is CapEx. That's what we just looked at. They spent $926 million on an acquisition in 2019. And sometimes they dispose of assets. Maybe they don't need it anymore. Maybe they exited that part of the business. For whatever reason, they gained $1.5 billion from the sale of assets in 2018, $142 million in 2019, and $426 million in 2020. They also received dividends from their investments in other companies. $245 million, $353 million, and $173 million. Remember when that dam collapsed and they had to pay out all that money? It looks like they got fined $1.6 billion. That's a cash outflow. So this is a judicial deposit of $1.6 billion. It looks like a court had them deposit $1.6 billion into an escrow account to be used to help that town. And the bottom part is cash flow from financing. So when a company adds debt or pays down debt, or adds equity or pays down equity, that's all in the CFF section. The top part is loans they received from third parties, $6.8 billion in 2020. They also pay down debt. These are the next two lines. Also, when they pay dividend payments to their shareholders or interest payments to their bondholders, that's also in this section. They paid $3.4 billion of dividends in 2020. They didn't pay any dividends in 2019, $3.3 billion in 2018. Let's look at the capital structure. $33 billion of equity, $18 billion of debt. They're 65% equity, 35% debt. Their net debt is $5.2 billion. Net debt is total debt minus cash on the balance sheet. And their weighted average cost of capital is 13%, and that's the highest WACC according to Finbox. The higher the WACC, the more conservative the estimate is. The WACC is a discount rate, so when you give a really low discount rate, your valuation will be high. If you give a really high discount rate, your valuation will be low. And 13% is the rate we're going to discount the future free cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $115 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $112 billion. We divide that by 4.9 billion shares. And we get a calculated stock price of $23. They're trading at $12, so they're trading at a 46% discount. It's a really strong buy according to the model. The average analyst projects their revenue to decrease 9.5%. So I decreased their revenue 9.5% for the next 4 years. I don't think it's going to go down that much for 4 years. But I did it anyway just to be conservative. Just to show you how undervalued this stock is. And to get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers. And 31% of their revenue is converted into free cash flow. So I multiplied their revenue estimates by 31%. That's how I got their future free cash flow estimates. Simply, Wall Street's at $16 a share. They're saying it's 25% undervalued. 9 analysts priced this stock and the average price target was $17. This is where the stock has been trading the last 2 years. There is a ton of buying and selling activity on this stock. Look how big these bars are. The bars down here are all the buy orders or sell orders. This is the price of iron ore the past few years. If you just look at it in 2020, how it went all the way up, then it came all the way down, it's fairly similar to the way this stock price has moved. Since a majority of their sales are from iron ore, the stock price is highly correlated to the price of iron ore. That's why it went up so much in the beginning of 2021, and now it's coming back down. And they paid that massive dividend because they brought in so much revenue and so much cash flow. But now the stock price is coming down a lot, and you'll see the dividend yield is through the roof. They pay a semi-annual dividend. They paid their highest dividend ever, $1.56 in September. That's a 22% dividend yield. But obviously the dividend yield can't stay this high, because if it stayed at 22%, everybody will put their money into the stock, a 22% guaranteed investment. But things always balance out. More people are going to buy the stock and push the price higher, which will bring the dividend yield down. Plus, I'm not sure they're going to have the same cash flow going forward as they did the past few quarters. Because as you saw in that chart, iron ore prices were really, really high, and they are coming back down. So it's really a supply and demand issue, kind of like anything else. The demand for iron ore in China has been decreasing, mainly due to the looming bankruptcy of Evergrande and other real estate developers in that country who are also pretty close to bankruptcy. China constructs so many homes because there's so many people, and the average income in that country has gone up dramatically. Percentage-wise, it's gone up dramatically. Dollar-wise, maybe not so much. But over the past 10, 20, 30 years, lots of people have went from poverty to lower class. Tons of people went from lower class to middle class, and from middle class to upper class. So people are looking to live in nicer places. They have a pretty low beta, 0.64, so the stock moves less than the market. It's not too volatile. The stock is down a little bit in the past 52 weeks, but if you add in that dividend, it's actually up 20%. The S&P is up 32%. The 52-week low was $11. The high was $23. And the stock is trading below its 50-day and 200-day moving average. There's a ton of activity on this stock. 50 million shares have been traded on average the past 10 days. 34 million shares have been traded each day on average the past 3 months. Of the 4.9 billion shares outstanding, 4.3 billion are on float. 26% are held by institutions, and less than 1% of the shares are shorted. The biggest shareholder is Capital Research at 31%, then Banco do Brasil, BlackRock, and then the holding company for Banco Bradesco. That's a pretty big bank in Brazil. They own 6%, and Mitsui. Let's look at their financial ratios. They have a PE of 3.4, which is just amazing. I don't think I've ever seen a PE this good on such a big company. A really good price to sales ratio of 1.1, a good price to book of 1.8. They have 8.9 billion of intangible assets, 3.2 billion of goodwill, 5 billion of concessions, and 500 million of research and development, and also patents. They have an amazing return on invested capital, 70%, unbelievable. They can cover their interest payments 12 times, an ROE of 53%, current ratio of 1.2, quick ratio of 0.9, over 11 billion of cash and short-term investments, 873 million of accounts receivables, and 5 billion of inventory. Even though they paid out a huge dividend, $13.5 billion they spent, they still have $15.8 billion of funding because they brought in so much free cash flow. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 11 companies in the same industry as Vale, and if Vale has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So their price multiples are so much better than average. They almost have the best PE, price to sales, and price to book of all these companies. Definitely the best price to earnings, almost the best in price to sales and price to book. They have a good current ratio. Their ROE is through the roof, higher than anybody else. They're a little higher in debt than the average company. 60 billion market cap, they're the third biggest company on this list, and they pay the largest dividend. If you compare this company to Rio Tinto and BHP, these are the three giant metal companies. In the trailing 12 months, each company was almost identical in revenue. 61 billion, 58 billion, 57 billion. Vale is the smallest, but they're all really close. In terms of free cash flow, Vale is easily the winner. 25 billion versus 17 billion versus 21 billion. So you would think Vale should be the largest company, but they're the smallest company by a pretty good amount. BHP, which is an Australian company, has a 133 billion market cap, more than double Vale. Rio Tinto is 106 billion. It's a UK company. Vale is only 60 billion. They should be 150 billion or 200 billion if this company is 133 billion. The main reason is because they are located in Brazil, and the valuation for companies in certain countries is lower, Brazil being one of those countries. Also, the dam collapsing and all those people who got killed probably didn't help either. So to summarize, I have them trading at a 46% discount So this stock is trading at a super bargain. An ROE of 50%, that means you just have to wait 2 years to get your investment back. And the fact that they're paying this huge dividend, it should give people a lot of comfort to drive the price higher. The stock should double, triple, but for some reason it's not. But I wouldn't wait too long because it may start coming up a lot. You don't want to miss the boat. I rank their free cash flows, revenue, and ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.